This is the Human Action Podcast, where we debunk the economic, political, and even cultural myths of the days. Here's your host, Dr. Bob Murphy.
Hey everyone, welcome back to the Human Action Podcast. In this episode, I am going to go over an extensive array of empirical evidence to convince you, dear listener / viewer, that the Federal Reserve under Alan Greenspan helped to fuel the housing bubble, and that the bursting of the housing bubble had something to do with the ensuing financial crisis and what we could now call the Great Recession that began in late 2007. And what I'm going to do also to motivate this discussion is present alternative theories. And interestingly, not alternative theories coming from Paul Krugman or Stephanie Kelton, but from other free market economists, colleagues of mine, right? So this is interesting where it's an area where I think the standard Austrian story even differs from that of many other nominally free market types. And I should say, partly I'm doing this because Alan Greenspan recently passed away, as I'm sure many of you knew. And so in the wake of that, there were people arguing over his legacy. And so these claims that I'm going to try to rebut coming from people who were trying to exonerate him, were resurfacing. In other words, people who had always thought, no, Greenspan got a bum rap. He didn't have anything to do with the housing bubble. Or sure, maybe he had something to do with the housing bubble, but the housing bubble didn't have anything to do with the financial crisis of 2008, right? Those are the two different claims we're going to be addressing, that those things came up in the wake of his death. And so I think it's appropriate to respond to them. But the other thing is, in terms of Austrian business cycle theory, the housing boom and bust was just a great example, an illustration, almost textbook, as we'll see as I'm going to go through some of these charts. So let me just mention, if you're listening to this in your car or something, you may want to save this one for when you're in front of a computer, because I am going to be going over a lot of charts. Also showing that Austrians aren't afraid of data, right? That's one of the misconceptions floating around social media, that, oh yeah, you Austrians are real dogmatic and you refuse to look out the window in case it falsifies your theories. So let me just clarify methodologically how that works in a Misesian framework. We can a priori go through and show how a central bank or a cartel of banks that has certain privileges and the power to exclude new entrants can pump in credit, push interest rates down to artificially low levels, and that can cause a boom-bust cycle, right? We can kind of go through that and say qualitatively that necessarily must happen given, the assumptions that you're putting in there into the analysis. So you don't need to go test whether that's true or not. But empirically, when we want to say, hey, something crazy happened in September of 2008 that we now call the global financial crisis beginning, what caused that? Well, that's definitely an empirical question, right? So for example, you can also use a priori analysis to say that raising the minimum wage, other things equal, particularly if it's binding, is going to cause unemployment to be higher than it otherwise would have been, right? And there were legislated minimum wage hikes going into the Great Recession and the financial crisis, right? But does that mean I think that, the reason the global financial system seemed to be in serious trouble in the fall of 2008 was because the U.S. raised its minimum wage a few times, leading into that? No, I don't think so. Even though I still agree that raising the minimum wage, other things equal, causes unemployment. Okay, so I'm saying just because you think, agreeing with Ludwig von Mises, that basic economic law needs to be spelled out deductively from axiomatic premises, it doesn't follow that when you're trying to say what was involved in a certain historical event having to do with the economy, that you can't use data or evidence, right? So that's what we're going to be doing in this episode. Also, I'll mention a lot of this I did in real time, that in the wake of the financial crisis and the onset of what we call the Great Recession, if you might remember, that's when Barack Obama is elected, has what was called the Obama stimulus package. And here is where I really grappled a lot with Paul Krugman. And he kept putting out stuff because Krugman was very much against what we could call a, quote, real or malinvestment theory of what happened, that Krugman wanted to say, no, the problem with the recession is it's insufficient aggregate demand. Don't worry about did too many resources flow into housing in 2005 and 2006. Whether or not that's true, Krugman was arguing when Obama was in office, the point now is people aren't spending enough, and so we need the government to run massive budget deficits, right? That's what he was arguing. And he kept coming up with evidence that he thought showed the malinvestment story, or what Arnold Kling was calling a recalculation story, where Kling was saying that the economy needed to recalculate after all the malinvestments in housing. And Kling's analysis was very sympathetic and compatible with the standard Austrian story at the time. And Krugman was pushing back against that, and he kept coming up with evidence that he thought showed it wasn't the case. And then I would come in, and I had just had a flurry of articles at Mises.org, many of which were reproduced in the book Contra Krugman that Tom Woods and I put out, the book version, not the podcast, where I would just pick up the gauntlet that Krugman would throw down and just show him, what are you talking about? So just to give one example, I'm not going to cover it in this episode here, but I'm just explaining why this episode of the housing boom and bust is so near and dear to my heart, because it totally vindicated Austrian business cycle theory. Is that Krugman was trying to show in one of his posts that, oh, hey, look, if we rank the states with the worst unemployment rates, and then we also rank the states with home price declines, the two don't really have much, there wasn't much overlap. And so Krugman was writing this, I think, like in mid-2009. I might be wrong about when he wrote that, but that was the argument he was making. But so I took his post and I was looking at it and I was like, well, wait a minute. That he was just kind of looking at the home price drop from that year or something. And so instead, what I did is I extended it back to the peak of the housing bubble years and looked at the home price decline from then and looked at the job loss from then, I believe. And I just showed that once you had a more accurate, like if you were trying to say, does the collapse of the housing bubble have something to do with the bad economy we were experiencing as of when Krugman's article came out, the natural time frame you would look at, I was saying, is not just the most recent year-to-date snapshot, which is what Krugman did. Instead, I said, let's go look at from when the housing bubble popped, and from that point to now. And then when I did it that way and came up with a way to show, like, look what happened to employment in these states and look what happened to the decline in home prices. And when you rank the states like that, it was like almost a perfect fit. That like the five worst states in terms of home price decline were the five worst states in terms of, I think I did the increase in their unemployment rate or something over that period, something like that. So that's what I mean is I was sitting back and then Krugman would come out every week or whatever with some new argument and appeal to certain types of data to try to show that, oh yeah, what's going on right now, the reason the economy is bad, it's not because resources floated in the wrong sectors. No, it's people aren't spending enough. And then I would just look at what he did and show, well, no, if you were going to test that hypothesis, this is the better way to do it. And boom, it would just jump out that the data were more consistent with the Austrian story than with the people just aren't spending enough story. Okay. Also, I should mention that plenty of Austrians were on record predicting the housing boom and bust. Right. So Peter Schiff famously, if you haven't seen it, you really should check it out. I'll put a link in the show notes page. But you can just go to YouTube and type in Peter Schiff was right, and you'll get a compilation. There's a few good ones that have hundreds of thousands of views to know you have a good one, where he was doing the rounds like on CNBC and all those like financial news shows in like 2006, early 2007, warning that, hey, housing is way overvalued, it's going to burst. And people were literally laughing in his face. And then, so he was vindicated on that score. And he was coming from a very Austrian-friendly perspective. Ron Paul, several times from the congressional floor was lamenting the subsidies that the George W. Bush administration was giving to home ownership and things like that. And what the Fed was doing was warning that the Fed was blowing up a housing bubble. Mark Thornton had a very prescient piece on Mises.org, so I'll link to that again, on the show notes page, if you want to see where the title was Housing Too Good to Be True. I think it was in 2004. And Thornton just went through, and what he said is this is what's going to happen was spot on. Like, he didn't, give a date, but he wasn't also just throwing out generalities. Like, he was saying the taxpayers are going to be on the hook to bail out, Fannie and Freddie and things like that. So anyway, it was really prescient stuff. And then for my part, in October of 2007, right, so that's 11 months before the financial crisis, I had a piece at Mises.org titled "The Worst Recession in 25 Years?" ? And I used standard Austrian business cycle theory to say that not only did I think we were poised for a crash, but I said, given how severe the distortion is here, how artificially cheap the Fed has made credit in the early to mid 2000s, I said the last time it was this severe was in the late 70s. And so I said, if you think that the distortionary malinvestment has something to do with the magnitude of the ensuing bust, then we're in store for the worst recession in 25 years. Okay, so with all that groundwork, let's go ahead and dive in here as I start showing you folks a flurry of images. So first, let me just establish what we're looking at this image is the connection between interest rates, U.S. interest rates, and the U.S. housing bubble in terms of price. All right. And so what we're looking at in this chart is the red line there is a home price index that is available from the St. Louis Federal Reserve website. So that's what I'm going to be using in this episode of the Human Action Podcast as a proxy for the home price bubble, right? This is an index across the U.S. And the particular units here are the percent change from a year ago, right? So that red line that it's pointing to the right axis is showing the year-over-year growth in the home price index. The blue line is showing the level of the federal funds effective rate. That's like the Fed's target rate. It's the overnight, it's the interest rate for overnight loans of reserves. But that's when the newspaper says the Fed cut rates today or held rates steady, this is the rate they're talking about. And the green line is the 30-year fixed rate mortgage average for the U.S. Okay, so what you can see there, that gray shading in the middle, that is the .com / September 11th attack recession that happened early on in the George W. Bush administration. And so you can see, for example, that blue line, it was around 6.5% leading up to that recession. And then the Fed started cutting rates drastically. By June of 2003, brought them all the way down to 1%, then held them there for a year. And then in June 2004, started ratcheting rates up 25 basis points, basically every Fed meeting. So you can see how it just ratcheted up there until it finally peaked at, I think, 5.25% in either late 2006 or early 2007. I can't make it out there from the chart. Okay, so I don't have it here because I only go back to the early 90s on this chart, but that federal funds rate of 1%, the bottom that it hit there from, again, June of 03 to June of 04, that was the lowest that particular interest rate had been since the 1950s. Okay, so that's a very low in nominal terms interest rate. Okay, and you can see that green line also followed the pattern of the blue line, though it wasn't as pronounced, right? That when that blue line came way down, that's when that green line, the mortgage rates, came down, right? So mortgage rates were like above 8% in early 2000, and then they just started trending down and almost got down to 5%, in 2000, late 2003, 2004-ish, right? And then they started trending back up again as the Fed began raising its target rate. And then that red line, to see, well, what was going on with home prices when the interest rates were moving like this, did just what you would expect, right? The red line going up is saying the year-over-year increase in home prices was accelerating. And you can see that kept rising and got up to about 12% where it peaked in late 2004, early 2005, and then started coming down. All right, so to be clear, when that red line first turns and starts dropping, that doesn't mean home prices were falling. That just means the rate of their increase was slowing. You have to get up to 2007, where it's basically on the chart where the red line happens to intersect that blue line, though that's kind of a coincidence just from the axes. But that is when it crosses the zero line, meaning from that point forward, home prices were actually lower than they had been a year earlier. Okay. But again, what am I doing here? I'm just showing this is what you would think, right? And it's not a crazy idea to think 30-year mortgage rates have something to do with the short-term interest rates from the Fed, but not as pronounced, right? Because a 30-year rate is building in like all the successive future short rates. And so if short rates drop, that's going to pull down the long-term one, but not make it follow it all the way down. And it also makes sense that as mortgage rates are dropping, home prices would go up, right? Because for a given monthly payment somebody can afford out of their paycheck, they can, quote, buy more house if mortgage rates are lower, right? So to the extent that you think interest rates would have anything to do with home prices, this pattern at least is totally plausible. Okay, so here what I'm doing, folks, just to make sure you get it, is I'm making the case that Greenspan's Fed, because Alan Greenspan was in charge of the Fed at this time, the late 90s up through mid 2000s. I'm making the case here that Greenspan's Fed had something to do with blowing up the housing bubble. And so I'm showing here, well, the Fed cut interest rates pretty aggressively down to, rates not seen since the 1950s. Mortgage rates fell. They were much lower in the mid 2000s, certainly than they had been in the 90s. If you look back at that chart in the late 80s, for sure, several percentage points lower. So it's not surprising that home prices were rising at unusually high rates. Okay. So what is one possible defense that Greenspan could use, or his apologists? And this is the one that he did use. So Greenspan himself later on said, tried to excuse himself. At the time, they were calling him the maestro, if you recall. In the early 2000s, there was a book, I think it was from Bob Woodward, came out literally calling Greenspan the maestro. There was, flattering cover stories in Time magazine and whatever. That was, I think, more in the late 90s. It was like called like the Committee to Save the World or something, right? And what that was doing was saying, among other things, they were congratulating Greenspan for having home prices rise even amidst the dot-com recession, right? The bursting of the dot-com bubble in the late 90s, the September 11th attacks, and so on, as the U.S. went into a recession in the early 2000s. But home prices kept rising. And so people were congratulating Greenspan at the time for that. So then later, when the housing bubble blew up and prima facie seemed to have something to do with the worst financial crash since the Great Depression, people were like, oh, wait a minute, maybe Greenspan shouldn't have blown up that housing bubble. And then now he was, whoa, I didn't have anything to do with the housing bubble. So what did he say? He said, it's Asian savings, right? That, emerging and domestic developing economies had this high savings rate that kept growing in the 2000s. They couldn't use their funds domestically, and so it all was flowing into the United States. So Greenspan is saying, yes, interest rates dropped, but we were just following the fundamentals, right? There was this huge influx of saving. And so, the equilibrium interest rate or the natural interest rate is going to drop. And so that's not our fault. We weren't pumping in artificial cheap credit is what he was arguing. All right. I'm paraphrasing, but that was certainly his argument. And then other people also agreed with that. So to rebut that claim, let me just show you this chart showing that blue line is the savings rate as a share of GDP, and the red line is investment as a share of GDP for emerging and developing economies. And so, you can see what they're talking about, that, the gap between those two, which is like kind of showing the excess saving that has to go abroad from these countries' perspective, was growing. Certainly, 2004, 2005, 2006, and that's right when the housing bubble was really getting blown up. So, okay. But then notice the gap doesn't shrink, right? So it would make sense to say, that inflated home prices, but it doesn't really explain then why did the bubble pop, right? If if the savings, those foreign savings rose and then collapsed for some reason, that might explain it. But no, that just kept growing. And also, just on its own terms, isn't that kind of weird to be saying, oh, the reason the globe had a huge crisis in 2008 was because a lot of poor people around the world were saving a lot a few years earlier? Just on its face, doesn't that seem kind of weird? All right, so I think what I can give is a much better explanation of that. Namely, look at this chart. I want to say that it was the Fed's monetary policy. Okay, so I don't have it here. Elsewhere, I've done it. In my book, Understanding Money Mechanics from the Mises Institute, I have a chart showing a broad rate, a broad view of like the federal funds rate and the monetary base. And it just shows how they move in opposite directions, just like you'd expect, that when the growth in the monetary base is high, that's when the federal funds rate is dropping. And then on the other hand, when the Fed's raising the federal funds rate, that's when the growth in the monetary base, falls, which again, that's like textbook monetary policy, like teaching at the undergrad level, that, when the Fed wants to loosen policy, it engages in more open market operations. It pumps in more money. The monetary base grows more rapidly, and then the target rate, interest rate drops, and then vice versa. If the Fed wants to raise interest rates, it has to slow the amount of new money it's pumping in the system. So the interest rate rise, right? That's textbook stuff. And so I'm showing here, was the growth in the monetary base in M1 high, in this period where we saw interest rates have dropped? And you can see there in the chart, following that recession in the early 2000s, that, they're in between 5 and 10%. You would say, like, in absolute terms, is that a big number? Well, look in the late 70s. The mid to late 70s, that's the same range that the growth in the monetary base in M1 were in, but between 5 and 10%. Does anybody doubt that it was loose money in the 70s that caused the stagflation of that era? So if between 5 and 10% of monetary base growth and M1 growth in the mid to late 70s, we think is responsible for the high inflation of that time, price inflation, then I don't see why it's implausible to say in the early 2000s that same amount of monetary stimulus could explain why interest rates dropped down to rock bottom levels. And, so that's my argument there. I think that, and also you can see in this chart that the rates, steadily went downward. So it makes sense. We can explain how was it that monetary policy first made rates drop and then made them rise steadily. It's because in the beginning of the 2000s, the Fed was pumping in a lot of money and M1 was growing as well. And then they started taking their foot off the gas. So that's what you would see. Again, in contrast, if you're saying, oh no, it was foreign savings that caused the housing bubble, yeah, you can link it up that foreign saving was increasing when the housing bubble was being inflated, but there's no popping going on there. Okay. So I think I've established that the Federal Reserve, at least there's a prima facie case here, that them engaging in loose money pushed interest rates down to artificially low levels, and that helped fuel the housing bubble. All right? And I dealt with a popular alternate explanation. No, it was foreign saving, and I think I showed that, no, that doesn't make as much sense as my theory. Okay. But now another interesting theory coming from a free market colleague who, on this particular issue, disagrees with the standard Austrian story, is to say, whether or not the housing bubble was Greenspan's fault, that's irrelevant, because the housing bubble and bursting wasn't what caused the financial crisis of 2008 and wasn't what caused the recession of that era. All right. And so that case is put forward by Alan Reynolds. So here we'll just put up 3 screenshots of tweets that he made when this stuff, in the wake of Greenspan's death. Okay. So we don't need to address every little jot and tittle of Reynolds' case here, but he's saying it has to do with housing. He's saying it has to do with oil. He's saying, it was, the record high oil prices going into the summer of 2008. That's what really choked the economy. And then the Fed, fearing inflation, kept rates high. And so Reynolds is saying, no, it was that 1-2 punch of tight Fed policy coupled with high oil prices that tipped the world into a recession. And, that's the issue. Okay. And he also says in these tweets that the housing boom and bust, that had already, that was long gone. That was ancient history by the time this thing happened. And so he's trying to say it just doesn't make sense, that his story fits the facts better. All right. So that's what we're going to spend the rest of this episode of the Human Action Podcast trying to rebut. Okay. So in this chart, I am showing that blue line, again, is the year-over-year increase in the home price index. And what we've got in green now is showing all U.S. employees in construction. All right. And so what I'm showing here is, again, I'm trying to just bolster the standard Austrian story of what happens in a boom bust cycle, that as the artificially cheap credit from the Fed pushed up the home price index, I'm saying that sucked hundreds of thousands of new workers into construction, right? You can see that green line moving up from mid-2003 until it peaks in early 2006. All right, just eyeball, looks like some 800,000 extra people getting sucked into that sector just from that point alone. And then as the home price index, the growth starts slowing, you see that green line peaks. And then it's once home prices begin falling year over year, right, when that blue line crosses that black line, that's when the amount of people employed in construction starts falling off a cliff. Okay? So that's kind of what you would expect to see. And again, this is consistent with the Austrian story of male investments. So that's, maybe I should just say this at this point. There's so-called real business cycle theorists, very free market people associated with the Chicago School, and they think a recession is entirely due to, quote, real factors. That's why it's called real business cycle theory. And that, money doesn't have anything to do with it. Whereas the Keynesians think money has everything to do with it, right? So the Chicago guys are, they think a business cycle is due to real factors. Keynesians think it's due to monetary or nominal factors, right? So that's why for the real business cycle theories, they don't want government deficit spending and, low interest rates from the Fed, because they're saying, no, that's just, the problem is, there was a technological shock or something, whatever. And there was some shock that hit the real economy, and that's why there's a recession, and, throwing money at it's not going to fix the problem. Just let it play out. Whereas the Keynesians like, no, the problem is the reason market economies get stuck in a rut is because there's sticky prices or whatever, that there's not enough spending. So the way to get out of that rut is the government has to come in and spend more. Okay. The Austrians have this interesting, the best of both worlds, I would say, is a very nuanced position, is they think it's monetary causes that fuel the boom. But then during the boom, there are malinvestments that are made. And so the reason the bust happens is that the economy is physically on a trajectory that can't be sustained. And so that's why just throwing more money at it isn't going to fix the problem. But it also shows why you can't just, stop whatever the problem was and then the thing's going to be fixed in 2 weeks. Because no, there really were malinvestments. Resources went into the wrong lines. And so that caused a definite problem. There's now a mismatch. The capital structure is internally inconsistent, and it's going to take time to wash that stuff out. I'll put a link in the show notes page. If you've never read it, a lot of people refer to it as my sushi article. And I think it's called The Importance of Capital Theory. But I get into there, if you want to see more on what I just said, about how the malinvestments of the boom period mean that the standard of living has to drop during the bust. Okay? So anyway, what I'm doing here is I'm just showing, consistent with that Austrian story, we can see in this chart that the inflated home prices, what people call as the bubble in home prices, was sucking workers into housing or into construction. And then one that's even more spot on. Just look at this chart, folks. I promise you, I did not tinker with Fred to get this to look like this. This was just the first thing. I took those two series and said, plot these together. And this chart, popped out. You never see connections this tight in macro data, unless it's like one variable is just a transformation of the other one, or things that, like in terms of accounting, must be equivalent. But what I'm doing here is the blue line again is the home price index year over year growth. And the red line now is privately owned housing units started. All right, so housing starts. And just look at the connection of that. That's going back decades. So that's an amazing fit. And so again, what this is showing, it's not surprising, but what is surprising to me was just how close that fit was. That as the year over year growth in home prices goes hand in hand with how many housing starts there are. Okay, so again, when we're trying to show how the financial distortions caused by loose money had a mirror image or a corresponding footprint in the real economy, this is like Exhibit A, even though here I've made it Exhibit B. I did the labor market earlier, right? So clearly what I'm showing is the wild boom and then popping of home prices sucked workers into construction and caused, the amount of housing starts to go up, and then to fall off a cliff, just as you would expect, okay? Now, let me show that contrary to what Reynolds claims, this pattern that I just documented helps to explain the onset of the Great Recession, right? Because he was arguing that, well, no, I mean, the housing boom and bust was already in the rear view mirror, so that can't explain the crisis that hit in 2008, right? But look at this chart. So here, that green line is the same as it was before. It's all the employees in construction. And the blue line now is different. Here, that's the national unemployment rate. Okay? And so you can see in the mid-2000s that as that green line's rising, right? So remember, we've already established more and more hundreds of thousands of extra workers are getting sucked into construction as the home price bubble is growing. And notice that goes hand in hand with a gently falling unemployment rate. And then when employment in the construction sector peaks and then starts declining, you start to see the national unemployment rate troughs and then starts ticking up. All right, now on that gray line there, that is showing that's the official start of the Great Recession, right? So the way that the NBER dates these things, they said, I think they do it monthly, that the Great Recession, they say, started in December of 2007. So that's what that shading is corresponding to. Okay? But notice the unemployment rate starts rising before that. All right? And you can see that it's like the mirror image of that green, the blue and the green lines there move in opposite directions, right? So as construction employment, initially surged, that went hand in hand with the falling unemployment rate. Then construction employment started dropping, and that's when the unemployment rate started ticking up. And then eventually the NBR says, boom. And at this point, we're officially in recession. But you can see the labor market was, quote, softening, many months beforehand. Okay. Now, what's interesting is you can say, all right, but, Bob, maybe that wasn't about housing, in general. If if the Keynesians are right, and there's just for some reason a slowdown in total spending for whatever reason, revenues fall or whatever, maybe construction employment was falling for other reasons. Well, look, I can disentangle at the top there, that dotted red line, that is showing total private sector employment less construction, right? So we're taking construction employment out of it, and that dotted red line is basically saying in the private sector, all of the, the total level of employment except for construction, whereas the green line is just showing the construction employment, right? And so notice that dotted red line doesn't turn around the same time the green line does. No, it actually keeps rising. And it's rising all the way up into the onset of the recession. And you can see it even lasts a little bit, like it's kind of just flat. And it doesn't really start falling until well after you're inside that gray band. All right. So in terms of trying to, if you're going to think that employment flows in different sectors, in some sense, anticipate the onset of the recession, you can tell a plausible story where, the problem, first hit construction, and that started pulling up the unemployment rate as people were losing their jobs in construction. But overall employment for the rest of the economy was still holding steady, and that didn't really start falling until later. Okay, so again, I think what else would the data have to look like to be consistent with the Austrian story that, there was a problem that in this particular cycle happened to, having the epicenter in the housing sector where there were all these mail investments made, then that popped, and then eventually that spilled over into the broader economy, right? This chart I'm showing isn't exactly what it would look like. And again, contrary to Reynolds' claim, I think this data show, the problem originated in the housing sector, and you saw it hit construction first, and then, it spilled over into other ones, and the timeline, matches up. Okay, so what about his theory of oil? Well, on this chart, I'm just showing oil prices in black and the unemployment rate in blue as before. And so here, just at first glance, that story looks plausible too, right? Reynolds isn't, a dumb guy, and that makes sense. That you see as the black line starts shooting up, that's when unemployment shoots up. So maybe that has something to do with it. But I would just point out one thing on this chart. You can see the rising black line there up through mid 2006 is consistent with the unemployment rate steadily going down. Okay, and so there, oil gets as high as, above $70 a barrel there, just eyeballing the chart. And that was consistent with falling unemployment. So the U.S. economy could handle oil above $70 a barrel at that point, and it was still consistent with the unemployment rate falling. And then oil, pulled back sharply. And then if you look ahead, it didn't regain that level until mid 2007, right? So my point is, it was by mid to late 2007 where oil still was not any higher than it had been earlier amidst falling unemployment in the U.S. So if you're trying to say it was rising oil prices that choked off growth in the U.S. and tipped us into recession, you don't have much time to play with. It's really only in the last few months of 2007 that oil gets higher than it had been back during the housing boom era. So I'm just saying I didn't just disprove the theory, but I'm just saying it does look to me implausible that it was just a few months there of high oil prices that all of a sudden caused the U.S. to fall into recession. That I don't think it lines up that well. And then as far as like the connection between the financial crisis in 2008 and so on, let me just show you. I have two more charts to show you just so you folks can pace yourself mentally. So here, what I'm trying to show is I think the oil price was a symptom and not the cause of the economic imbalances of this period. All right, so if you remember back then, what was happening is China was growing rapidly, and going into 2008, and I know that, like, I was testifying before Congress and stuff on this stuff. So, I was really on top of these things at the time, that the spare capacity on planet Earth in the oil sector was very thin. Okay, and so that's why prices were, the insiders were saying that's why prices were being bid up, is because people were concerned that, if anything goes wrong, we've got a mismatch. That, global demand right now is higher than global supply. If anything goes wrong, like, a source kicks off, or, if there's a shipping disruption, or if demand should, rise a little bit more than supply growth can keep up with, we've got a very small margin at this point. And so that's why they were arguing that prices were high. And so consistent with that, let me just show you this chart. The blue line is the stocks of crude inventory in the United States, the commercial stocks, and the red line is the West Texas Intermediate price of oil. All right, so that's a standard benchmark for U.S. oil prices. And so what you can see here is in July of 2007, those crude stocks peaked, and then as the price kept rising, they fell off a cliff, and they fell all the way, they crashed pretty hard down to January of 2008. And so what I think was happening there is, amidst the rising prices, that the people in the U.S. oil sector, at least, the ones that are being captured by this data, there could have been private speculators that were, stockpiling inventory that don't show up in these EIA data, but still, from what we have to work with, public data sources, that the oil inventory, so oil held above ground in storage is what that blue line is showing, that as oil prices were rising, they were throwing everything they could at the problem, right? They were drawing down their inventory to try to quench this insatiable demand. And then it's true, it bottomed out, and then from January of 2008 started rising again, but I would argue that wasn't because speculators were coming in and trying to, hold oil off the market and then carry it forward in time and sell it, at a profit later on for a capital gain. I think it was just that you could see that blue line was pretty low at this point. You have to go back 3 years or 2.5 for that blue line to be as low at that point as it was before. And so I think the idea was simply that, they drew down their inventories, prices kept rising, the demand just wouldn't stop. And so finally they started to rebuild again. But then notice it peaks in like June, I think, of 2008, and then falls again. And that price just kept going up. Okay, so this story to me, and then once the price collapsed, then the inventories went up. But that makes sense that once, oil prices fell through the floor because the globe tipped into recession, then people built up their inventories at the cheap prices. That makes sense. Okay, and what I'm saying is this story does not at all look like speculators were hoarding barrels, pulling them off the market, and then that was pushing up the price, and it was like a self-fulfilling prophecy. To me, it looks like the exact opposite, that the fundamentals were strong, global demand to use oil just kept surging going into the summer of 2008, and that the oil sector was drawing down inventories in the beginning in an attempt to placate that demand, to feed the hungry hippos, and then and then finally they didn't replenish really until the price dropped. All right. Last chart I'll show you. In contrast, when it comes to housing, no, there is clearly a telltale sign that there was a speculative bubble. So this chart is showing the homeowner vacancy rate in the United States. And so you can see there, when does it shoot up? You might think, did it shoot up right after, after the recession hit and then people were getting evicted? No. Look at this chart. It zoomed up right after, in 2005. And then it started falling after the recession hit and then just kept coming down afterward. So what this is capturing is not people getting evicted. No, what this is capturing is in 2005, 2006, 2007, more and more people were buying homes that were homes to live in. Like they weren't renting it out, but they weren't living in them. Well, why would they do that? Because they were flipping houses. This was the housing bubble years, right? People were like taking their pensions and going and buying 2-3 houses in Las Vegas or whatever because, oh wow, you're going to earn 12% a year. This is great, right? That's what was happening in this era. And so one of the telltale signs that there was a bubble, a speculative bubble, that people were buying not because of the fundamentals, but because they hope to gain price appreciation, is that you would see the vacancy rate spike, which is exactly what we see here. Okay, so again, to try to understand the connection between these sectors in the financial crisis of 2008, it totally makes sense that a bunch of people were speculating on home prices, thinking the prices were just going to keep going up. And then when that stopped happening, a bunch of individuals were caught with their pants down, whereas you don't see anything like that in the oil sector. It's not that a bunch of people were accumulating oil inventories and were making big bets in derivatives, and then when the price came down, they were caught, and that's why there was a problem in September of 2008. No, that's not at all what happened. And just remember, everybody knows like what was going on in September of 2008 is it was like the collateralized debt obligations and mortgage-backed securities, and it was all the credit default swaps and stuff that had been issued on mortgage-related derivatives. That was the issue. Okay, so again, I'm just showing the objective data here, plus everyone who lived through that, just the memory of what the headlines were reporting. It's not a myth that the reason the globe was in trouble financially in the September of 2008 was there had been a bunch of financial deals related to housing that turned out to not be smart in retrospect. Okay, so I'll wrap it up there, but I think I've established that contrary to some of his defenders, Alan Greenspan's Fed really was guilty of fueling the housing bubble. And then once that popped, that had something to do with the onset of the Great Recession and the financial crisis of 2008. And big picture, Ludwig von Mises was right. Alan Greenspan was wrong. Thanks for your attention, everybody. See you next time.
Check back next week for a new episode of the Human Action Podcast. In the meantime, you can find more content like this on Mises.org.